Okay, welcome to Realcomm Live, the Capital Efficiency Podcast with me, Ben Muwoki, and Joe Aamidor. So I'm Ben, I'm the co-founder of LMC Search and Talent Selection. We focus on a climate tech, smart building, energy transition market. And I'm here with Joe. Joe, could you give yourself an introduction?
Yeah, Ben, thanks for having me. Joe Aamidor, I focus on product market strategy for smart building vendors. So that includes vendors across the tech stack, and I typically work with them or their investors to help formulate better product strategies. So that can be competitive analysis, that can be voice of customer, that can be diligence before making an acquisition or an investment in the space. And a lot of the work I do is just digging into the business behind how buildings become smarter and how companies can execute on a strategy to do that.
Yeah. So we're here to talk about just that. You've been looking under the hood on the energy management tech space, and you've dug into the numbers, which I know in the previous release everybody's been really excited about. What made you want to explore capital efficiency specifically right now? Yeah,
so there's been a prediction in this market for years that there will be more consolidation. And if you look at the state of smart building technology, you have a variety of different types of companies. You have large OEMs that make physical products that are in the building, sell services. You have companies that provide facility management services. And then you have a whole host of startups. Like a lot of parts of our economy, this is a really innovative space.
Yep.
And in addition to those different types of companies coming at different angles, and there's probably more than that, but those are the three main ones, you also just have dozens of companies. So it's natural to say the market is fragmented, there isn't a winner, there are maybe some emerging leaders. What's next? Oh, there will be more acquisition activity. There will be more M&A, but we haven't seen that. So in just work I've done with clients in just topics I've discussed in my newsletter, what's come up is the fact that I've been asking myself, why haven't we seen more consolidation? Why haven't we seen some maturation of this market? And that's the question I wanted to answer, right?
Yeah.
And I worked with somebody else, Sean Stewart, a friend of mine, to try to explore why aren't we, what's the next step for this market, and why haven't we seen more companies sell, be acquired, more consolidation in general?
Okay. So with you and Sean, with the research, what you found, I think one of the things that I noticed, that you broke down two key metrics that you looked at.
Yeah.
Square footage and capital raised. Why did you think those mattered in particular?
Yeah, so it's a great question. There have been a lot of different assessments of this market, and a lot of them are based on, and I don't find fault in those, but a lot of them have been based on, we review the products, we identify most innovative product. What I would say is, a lot of products are fairly similar. In addition to being fragmented, we have a lack of differentiation. There is some, but if you think there's a market of 50, 80 companies, you would expect there to be a lot of differentiation in what they do.
Yeah.
In reality, there may be, but they all deliver a similar value.
Yeah.
So what we did is we said, well, what public data can we find? And the key here is that we're using public data, and the two numbers that I think are fairly representative of what's happening in the market are square feet you've scaled to. Buildings is also good. The problem with buildings is there's different asset classes of different average sizes. So square footage is a number, and there's a lot of companies that will go out of their way to say, we've been deployed in 300 million square feet. And then the other one is how much money they have raised. And that's critical because there's a wide variety of how companies have scaled in this market, from we've raised a lot of money, we've spent a lot of money on getting our name out, and then other companies that have said, no, we're just going to be organic, we're going to do it organically. And over the 15, 20 years I've been in the industry, I've noticed that some companies raise a lot of money and you see their name everywhere. Yeah. There's other companies that don't raise a lot of money, but they have some staying power. So we took those two numbers. What we ended up doing in the analysis is we said, let's take total square feet that you've deployed to, and then let's make a capital efficiency metric of dollars per square foot, right? So there are companies that have scaled a lot and have raised a fair bit of money. There are companies that have not scaled a lot that have raised a lot of money. And then the reverse is true. There's some companies that have not raised a lot of money but have scaled. So that dollar per square foot metric or metric is what we used in addition to just how much have they deployed to.
Right, okay. And so you, with that in mind, you plotted companies into 4 quadrants, I think it was. Yeah,
so
walk us through that.
Yeah, so I can walk you through the methodology a little bit more. So Yeah, so we have a quadrant, like a lot of people have quadrants, and again, there's different ways to map a quadrant, but we took data for about 24 companies where we were able to get both of those metrics. Really, my initial list was 50 to 70 companies, right, where I would love to have gotten numbers for both, but we just weren't able to. So we had those numbers, and then what we did is we said, well, let's look at how much square footage they've deployed to, and let's look at the median. And the median number there is 95 million square feet. So the averages are a little bit higher, right? Because there's some companies that have gotten into hundreds of millions of square feet, but 95 million. So that becomes our x-axis of the quadrant, and then the y-axis, or the midpoint of the y-axis, is 12 cents per square foot, right? So companies, the median company is they've raised 12 cents for every square foot they've deployed to. And again, that number has a lot more variance. There are some companies we found that had a capital efficiency of 4, 5, 6 cents, really good, very capital efficient. There are other companies that were in over 50, 60 cents,
wow.
So far higher. Yeah. But when you lay that out and create an XY graphic or quadrant, you can then put companies in each of those 4 quadrants, right? They're either more scale than 95 million or less, and then they're either less capital efficient or more capital efficient.
Right. So let's start with the leaders then. High scale, high efficiency. What are they doing right? And should they be raising more money to strike while the iron's hot?
Yeah, great question. And I should note, between my newsletter and a couple other articles we wrote and a podcast we actually did with Sean and Lewis, your co-founder, there's a lot more just where we've discussed the methodology. So because I realize there's a lot to unpack. Leaders are interesting. In general, they're the companies that have gotten into hundreds of millions of square feet, but they've done so in a very capital efficient way. So they've raised, in some cases, low tens of millions of dollars, but they typically haven't raised outsized rounds. They're typically 12, 13, 14 years old. And I would say they're in a good position in that they have growing businesses. It seems like the key there is not that they've raised the most money, it's that they've been able to progressively or consistently grow over that period, right? It hasn't been, if we raise, we can grow. If we can't raise, we can't grow. They've always found a way to grow, and some of them just haven't raised on any type of cadence. It's just, oh, well, we got to a point where we had something we wanted to do with the money. We saw an opportunity to raise money, but it is less of a, we're raising because that's what companies do.
Yeah.
And what that's given them is a lot of optionality. I think that I don't believe that this market has a winner take all, but I think there's maybe winner take most, or some winners take many, if you think of it that way. And I think these are the companies that are in that position where they will be around. There's a lot of reliability if you're a buyer or a user in working with a leading company, right? A company that is pretty capital efficient, that is into hundreds of millions of square feet. I also think those companies could look to some of the other peers on this competitive map and say those are companies that can either give us a new asset class, those are companies that can give us a new suite of capabilities, or can just give us a lot of clients. And I think that gets into the other 3 parts of the quadrant.
And so the other one that I noted from your newsletter and the podcast was the Sell the Book crew.
Right.
And so they've scaled up, but burned a ton of cash, or that's what we can deduce from the data. What's the play here? Can these companies actually grow into their valuations?
Yeah, so these are companies, the Sell the Book quadrant, where they have scale. They typically don't have as much scale as the leaders, but they're still in low, think of them as low hundreds of millions of square feet. 200, 300 is kind of a good number to put around it. So they're in enough scale that they have solid clients, but they've raised, in most cases, more money than the leaders. Right. So they might have taken more of a typical venture path. I'm raising because it's been 2 or 3 years, I'm putting that money to work. In most cases, what I've seen anecdotally is that money has gone to sales and marketing. And that doesn't always pay off because the sales cycles just remain long. The flip side, and something we didn't talk about, there's very little churn. So having a hundreds of millions of square feet book of business is a valuable asset, because most of those clients are not going to go away, and not going to go away en masse, right? So even if you aren't growing a lot, you're probably not losing scale. So to your direct question, those companies could focus more on a specific asset class, could focus on a category, a suite of capabilities. I also think they could try to raise some money with the goal of acquiring and rolling up or consolidating some of their peers.
Sure.
But I think that one is a little bit tenuous because they've already raised enough money that their valuation might be, their on paper valuation, based on what their last round was, may be off their actual valuation.
Yeah.
And multiples have come down a little bit over the past couple of years. So those companies, I think, have some decisions to make. What do we want to do? Can we grow our way out? I will say, since we've published this research a couple weeks ago, a number of companies have reached out, and generally we've, even from vendors that maybe aren't in the most strong position, have said this is a great analysis, right?
Yep.
You creatively took some public data, you were able to pull it together, and actually provides a benefit to the market.
Yep.
Benefit being visibility.
Yeah.
And I think what I've heard from them is we're trying to focus on a new asset class, we're trying to focus on a core asset class, we're trying to focus on a suite of capabilities. And I think those are good options given where they are. The book of business, I would say, if they decide, we want to liquidate the position that we have in our company, we want to go join a larger company, I could see them having some value, but the valuation there might be tricky.
Yeah, that's something they need to work through. So then we're with the sell the tech,
Yep.
the third part of the quadrant that I know Lewis and I found quite fascinating. Small scale, but really efficient.
Yes.
So should these guys be targets for acquisition? Is that the play?
So in the sell the tech companies, and we tried to come up with a name that encapsulated the quadrant, right? So it was memorable, right? So like, I would say the sell the tech companies, there's a few options here, right? On one hand, and I even here at Realcomm, spoke to a couple investors I ran into who I would say are a little skeptical of this space. And if you look broadly, and one of the reasons we did this research, there haven't been a lot of exits. There's been a lot of money. I mean, our research of the companies we profiled, we're talking, I think $600-700 million in venture capital has been invested. So, quite a bit of money.
Yeah.
Additionally, they're in a few billion square feet. So again, that's not, you've got 90-some billion square feet, 96 billion square feet in the US. So this is not the majority, but it's a good share, a good chunk. So it's a good sample set. But the point of those companies, they actually have quite a few options, right? They could go raise money. I think the view of the investors I've talked to is we're skeptical of the space. There are, I wouldn't say diamonds in the rough, but there's definitely some gold if you're willing to pan for it, or potential gold, and that sell the tech category is probably that representative of that, right? They're still in a position where they've raised not so much money, that their valuation probably makes sense. They have some opportunity to continue growing. They're clearly doing something right because they're able to close business without having the same scale from a team point of view, the same marketing budget that some of their peers do. And maybe they found a good place to differentiate. One person I ran into earlier today, we were talking about this research, one of his fundamental views that he shared with me was that maybe some of these companies just shouldn't raise venture capital. So that could be what those sell the tech companies are actually thinking anyway, right? We actually don't want to raise a lot of money. We just want to do it organically. We want to grow. We want to do well by our clients, deliver value. But I also think those could be good acquisition targets in that you're probably going to be able to get to a fair valuation that works for both sides, both parties.
Okay, well that is a really interesting spot for them to be in. And then the final quadrant, emerging. So, I think you labelled this the wild card quadrant. Younger, less efficient, not scaled.
So
are they too late?
So that's a great question. You could say that's a very heterogeneous category. So while they're typically have raised too much money and are not very capital efficient and they haven't scaled, the companies, some of them, they're younger, right? And all these companies are pretty old, right? On average, we're over 10 years, which is interesting. A lot of people would view this market as being a newer market or a lot of recent innovation. But most of the companies who have been in the smart building space are over 10 years old. Some of them founded the business and 2 or 3 years later went to market, so they feel a little bit younger, but there's not a lot of purely new entrants, let's say since the pandemic, right? Which you could put that at least a memorable kind of time stake in the ground. those companies, some of them, I think their view is that we haven't really focused yet on going to market. We've been focused on building and building our product and refining it. That's a little bit risky because you've spent a number of years building a product without getting a lot of direct validation. And I would say people buying or not buying your product is really good validation, right? Are they willing to spend money on it? So there's some of those companies. I think there are some companies that maybe viewed the market with a little bit more ambition. We're going to raise more money, we're going to outcompete our peers, and if that didn't work, you've already raised and spent that money. So you've kind of tried and run a play. The play maybe didn't work how you wanted it to work out, and then what do? Now you find yourself kind of in this emerging category. They could be acquisition targets, but I think they're generally going to have to probably come down in valuation. The other challenge those companies have had is many of them raised after the pandemic, 2021, 2022, that was when multiples were just quite a bit higher. So those companies were able to raise more money at a higher valuation with an expectation we'll grow into it, and maybe they've had the most trouble growing into it.
Things have definitely changed.
So things have changed, right? So the question for them becomes, what do you want to do? Do you want to keep trying? Do you want to become more efficient? Again, back to my earlier point, I don't think even those companies are at risk of imminently closing down or shutting down, right? I think they have enough, just looking at how much scale do you have, putting an estimated price, this is how much money we think you can charge per square foot, look at how much staff they have on average, you can kind of do the numbers and say, these companies are not hemorrhaging cash, and they probably could get to a position in relatively short order to at least keep the lights on. I would say that's not a zombie company, as some people have noted in responses, but that's a company treading water. So the companies could stick around. It just becomes a question of, where does this lead you in 5 years if you're still in that position?
There's a lot to unpack, so I'd encourage people, if they haven't read this section of the newsletter, to take a peel at it. Right, so if we pause from the kind of quadrants and then jump into what I found really interesting in that podcast, M&A. Everyone's talking about it, but not many people or no one's doing it. So in your view, why hasn't it happened yet? Or why hasn't it happened in the flow that we'd expect?
And I have, and I maintain an M&A tracker. So there definitely has been M&A. The thing is, there hasn't been an uptick in general in M&A, and I would also argue you do have some new entrants. Sometimes those are the hardest to get data, so they haven't maybe, the numbers 10 plus years old, there are companies younger than that. So that makes the market in a bit of stasis, right? Some companies get acquired, but new companies enter, or companies grow what they do, so they kind of become more competitive. Anyway, the M&A question. A few people have reached out to me, and we kind of came to the conclusion there's sand in the gears of this market. If you think of a market being companies try, they raise money, they grow, there's consolidation, there's more innovation somewhere else, then there's consolidation. If you think of that just a normal cycle of a market, we're not seeing the consolidation phase happen. And based on this research, I could take a few points of view. One, there are some clear signs of types of companies that should probably investigate selling. There are companies that should investigate growing through acquisition, but I could very easily make an argument why none of them want to do that. And I would say companies that I've talked to directly that kind of admit, like, we've raised too much money, they don't seem to then say, so we should sell at a fair number and get some money back. The other dynamic, if you look at companies over 10 years old, the typical life cycle of a venture fund is not more than 10 years. So some of the venture capitalists who may be majority stakeholders or shareholders in these businesses might say, well, we've kind of written that off as a zero. We've moved on to our next fund. We hope they are successful. We're happy to see them continue to try and be successful, but it's not really a priority for us to figure out what's the exit for this business. We've already returned that fund. So I think my takeaway, kind of quick takeaway, this is a really useful roadmap for what M&A could look like. But I can see reasons why we just won't see that much more M&A.
Okay. Well, we're running out of time, but if you're a founder listening, or if you're a VC or PE, where can people find the full analysis in your newsletter to get a deeper dive?
So the newsletter is Smart Building Insight. It's on Substack, so you can go to Substack and find it there. We wrote an article in Thesis Driven, which is a friend of mine has a PropTech publication. There's a podcast, so if you go to our podcast feed either on Spotify or on YouTube, you'll see that. And then I think in the show notes, we'll have links to everything. You can also just find me, Joe Aamidor, on LinkedIn.
Fantastic. Well, Joe, as always, the level of insight is just staggering. And it's a really, really interesting conversation that I think we're going to hear more as we walk around Realcomm. So thank you very much.
It's a good time to be here at Realcomm. Yeah, thank you, Ben.
Awesome. Thank you.